Background: The Business of Exchanges, a Crash Course. Part 4: Major Players. Hopefully you enjoyed the history of the exchanges and gained an appreciation for the capital markets. I, for one, think that capitalism and the tools it provides, in this case the exchange, are what has enabled much of the acceleration in technological innovation. Anyway, now that you're familiar with the instruments you might encounter and have some history to fall back on, let's meet some of the major players. I'll continue to reference the bookstore as an example in this section to provide a real-life scenario for easier understanding. Part 2 of this background exchange breakdown, Part 2, Types of Instruments, we introduce you to your growing business empire, Old Book Inc. You may have noticed we glossed over and skipped the part about how your business sadly had its IPO, initial public offering, and immediately became a big success. In this part of the letter, let's consider the journey it would take to get there from the little-known company to one that is publicly listed on a big exchange. In real life, this process is very long and presents numerous challenges and obstacles to achieve the necessary conditions to its list publicly. These could include securing funding, meeting regulatory requirements, and building a strong market presence. However, none of these would be possible or would be very difficult in today's financial system without some of the major players that make it all happen. So who are these major players? They include institutional investors, like hedge funds and pension funds, regulatory bodies, such as Securities and Exchange Commission, market analysts who shape our public perception. Let's meet these players and explore how they interact with our business, Old Book Inc., or operate as fellow players in the marketplace. To gain a deeper understanding, we'll look at this from two perspectives. First, as the owner of Old Book Inc., you'll be dealing with these players directly, negotiating with investors for capital and complying with regulations, and responding to market trends. Second, as an individual investor, managing your savings in retirement. You'll be on the other side, evaluating companies like Old Book Inc., deciding where to invest and what methods are open to you. By exploring both angles, we'll see how these interactions shape the business and your financial journey. Brokers, the financial intermediaries. They say when selling something, it's most important to sell yourself. But in financial markets, who helps with the selling? Remember when you first decided to take Old Books Inc. public? You didn't just march up to the exchanges and list your shares. You needed intermediaries, brokers, who could navigate the complex terrain of financial markets on your behalf. As the owner of Old Book Inc., think of brokers as the real estate agents of the financial world. Just as a realtor helps you find the perfect house, a broker helps investors find the right securities. They don't own the assets themselves, but facilitate transactions for a commission. In other words, they work as matchmakers in markets. From a business perspective, brokers can help raise capital, example, issuing stocks or bonds, managing employee stock option plans, or advice on mergers and acquisitions. The only type of broker companies usually interacting with as a business would be full-service brokers. More on them later. Example of a full-scale broker that you could interact with are Morgan Stanley or Merrill Lynch. Typically for their advice, they charge a premium of 5 to 7% of the stocks you sell through their services. Investors. As an investor, you also interact with brokers, but your relationship is more transactional. An investor uses brokers as a gateway to buy stocks on the market. However, an investor could interact with 3 different types of brokers. One type, same as the business side, is the full-service broker. Full-service brokers provide investors with a wide range of services, from personalized investment advice to portfolio management, retirement planning, tax strategies, and many more. They try to provide all the bells and whistles of either allowing you to manage your own portfolio or connecting you with someone who will. The downside of using them is their higher commissions. How can you escape these high fees? You could use a discount broker. Discount brokers are considered the financial equivalent of a do-it-yourself alternative. They provide a platform to buy and sell securities, maybe some basic research tools, but little to no personalized advice. However, your costs are much lower, often free or just a few dollars per transaction. Examples include Charles Schwab, E-Trade, Questrade, or Robinhood. The last type of broker you could encounter, but only if you manage a lot of money, are institutional brokers. Institutional brokers focus on clients such as pension funds or sovereign wealth funds, charity foundations, and insurance pools, and specialize in executing large transactions. These brokers have sophisticated algorithms and strategies to prevent your stock price from swinging wildly when large volumes change hands. Market makers, liquidity providers. In brokers, we have the mechanism that enables buyers and sellers. However, what do you do when you don't have buyers and sellers? Meet the market makers. Market makers are like the oil that keeps the financial engine running smoothly. They stand ready to buy and sell securities, ensuring there's always a market. In our bookstore analogy, they're like the wholesaler who always have books in stock, making sure customers can always find what they need. For example, when we started trading Old Book Inc. on exchanges, you noticed something interesting. Even though Old Book Inc. isn't exactly Amazon in terms of trading volume, investors could still buy and sell shares relatively easy. This liquidity, amount of available to buy or sell, comes from market makers. Market makers maintain an inventory of Old Book Inc. shares and stand ready to buy or sell at a publicly quoted price. If someone wants to sell 100 shares but there's no immediate buyer, the market maker steps in to purchase them. Similarly, if someone wants to buy 100 shares but no retail investor is selling, the market maker sells from their inventory. Let's assume Old Book Inc. shares trade at $25. The market maker might buy your shares at $24.95 and sell at $25.05, making a 10-cent per share profit on the spread. This might seem small, but multiplying it by millions of shares across thousands of companies, you can see why firms like Citadel Securities and Virtue Financial are enormously profitable. For Old Book Inc., market makers ensure that your stock remains liquid, giving investors the ability to enter exit positions with confidence, knowing there's always a counterparty ready to trade. Clearinghouses, the unsung guardians of trades. So you've got brokers connecting buyers and sellers, and market makers who ensure trades are always made. However, we forget to go over something crucial that happens behind the scenes, the market transaction insurer. For a moment, let's look back at our farmer's market analogy. If you want to buy something, you give cash to the vendor, receive the goods, and it's done deal. But what happens after the handshake deal if it's happening on a global financial network where buyers and sellers never meet? Who's responsible for ensuring the deal goes through without a hitch? This is where clearinghouses enter the picture. Think of them as the referees of the financial world, quietly ensuring every trade is complete and no one gets stiffed. They're truly the unsung heroes of the market, as without them, or guarantees, no transaction could occur as fast as they do. Let's examine the mechanics. When you place an order to buy shares of XYZ Corporation at $100 per share, your broker sends the information to the exchange. Once your order is matched with the seller in the exchange's order book, the transaction doesn't end there. It's merely the beginning of a carefully orchestrated process. The trade information is immediately sent to a clearinghouse, such as the National Securities Clearing Corporation, NSCC. The clearinghouse acts as the official witness to your transaction, and more importantly, becomes the guarantee that within the standard settlement period of 2 business days, known as T+2, you will receive your shares at the agreed upon price of $100, regardless of what happens in the market during those 2 days. The clearinghouse simultaneously collects the information from the seller's broker and essentially inserts itself between both parties. In financial terms, the clearinghouse becomes the buyer to every seller and the seller to every buyer, assuming the counterparty risk that would otherwise exist in the transaction. A colorful way to understand this system is to consider the well-regulated version of what you might otherwise be a shady deal, a drug drop-off. Imagine you agree to buy something at price X and give your money to an intermediary. This intermediary must secure the product from the seller they contacted, or if the seller backs out, obtain it elsewhere, potentially at a higher price, to fulfill their obligation to you. If the original seller disappears, the intermediary must deliver what was promised, even if it cost them more than what you paid. But keep our business owner hat on the moment for Old Book Inc. The clearinghouse guarantees our sales when we sell something or similarly buy other items. Investment banks, the financial architects. Now that your stock is trading and liquid and your company expands quickly, suddenly a competitor presents an opportunity for you to buy them out. But how do you determine what price you should pay, how to get a loan from the public, arrange a deal, etc.? You try to talk your broker. However, you need more sophisticated financial services. This is where the investment bank comes in. Investment banks can help raise debt, find interest rates investors will accept, or ensure your offerings sell successfully. You engage in an investment bank like Goldman Sachs or JP Morgan to value their target company, structure the transaction, whether cash, stock, or combination, arrange financing, perhaps a bond offering to raise the necessary capital, negotiate terms, handle regulatory filings, and close the deal. Their fee, perhaps $1.5 million on a $50 million acquisition, seems steep, but their expertise helps you avoid pitfalls and secures favorable terms. Investment banks also serve as underwriters for security offerings. When, for example, our Old Book Inc. issues $100 million in corporate bonds to fund its e-commerce expansion, the investment bank helps determine the appropriate interest rate, find buyers for the bonds, guarantee the sale by purchasing any unsold bonds, and handle all documentation and legal requirements. In return, they own an underwriting spread, perhaps 2% or $2 million, compensation them for their services and the risk they assumed. As investors, you won't typically interact with them, but are important players you should be aware of. Hedge funds, financial acrobats. When we think of dramatic financial movies and iconic Wall Street characters, hedge funds often take center stage. These sophisticated investment vehicles have unique characteristics that set them apart in their financial ecosystem. Unlike regular investment funds, hedge funds have greater flexibility in their strategies and fewer restrictions on what they can do. They can use leverage, borrow money, short selling, derivatives, and other complex instruments unavailable to typical retail investors. While you may not directly interact with hedge funds as a business owner, they can significantly move markets and affect your company's stock. Unlike mutual funds, which typically take long-term position, hedge funds employ diverse strategies. Some might implement a short-long equity approach, buying Old Book Inc. while shorting your largest competitor, betting on your relative outperformance. Others use event-driven strategies, investing based on an announced acquisition because they believe the market has undervalued the potential synergies. Activist hedge funds might push for change in your business strategy or financial policy. In contrast, quantitative funds might trade your shares based on purely statistical patterns, holding positions for just hours or minutes. Some hedge funds could become valuable long-term partners, providing capital and insight. Others might be short-term traders, creating volatility in your stock. You are unlikely to interact with them either as a business or as an owner or as an investor. However, you are affected by their positions and actions. Regulatory bodies, the market guardians. In history, you saw how there were a lot of crashes, especially in the late 19th into early 20th century, and a lot of fraud. Even though there were rules and gentlemen's agreements on how business should be run, sometimes, as the joke goes, if nobody ever saw you break the law, did you actually break it? Financial regulators take on the policing role, enforcing rules and holding companies accountable for their financial fraud. The primary function is to protect investors, provide stability, and indirectly ensure that the rules aren't so confusing that no one knows what to do. Both business and investors see the effect of regulator through the same methods. As business owners, regulators provide a rail track for your accepted behavior. You work to please them and make the environment as safe as possible for investors without revealing your business secrets. For investors, the regulators provide the framework in which you can learn about information. Companies disclose following standards that you can use to understand businesses and make informed decisions. Old Book Inc. must now file quarterly reports such as the 10Q, or annual reports such as 10K, disclosing material events promptly, 8Ks, following strict rules regarding insider trading, maintaining proper accounting standards, providing accurate information in timely manner. The relationship isn't adversarial. Regulations aim to maintain fear, order, and affect market that benefit companies like yours by ensuring investors' confidence. However, compliance requires significant resources and attention to your management team. This also makes it so investors can trust your company, and the more investor confidence you can bring through accurate data, the more information investors can accurately assess risk. Let's recap. I know that may have been a lot of information, so let's try to summarize it in a few words. Brokers, they enable buyers and sellers to meet. Market makers ensure that there's always buyers and sellers of securities. Clearinghouses, they're the unsung guardians who are the insurers of a transaction. Investment banks, financial engineers who help businesses by providing consultation or stamps of approval on values. Hedge funds, they're the big players in the marketplace. Regulatory bodies are the police of the financial world. They ensure that no rules are broken and investors are not misled. Although I have spanned the different functions of these businesses into different categories, many companies that start in one category go through vertical expansion, meaning they expand business activities into different areas that the previous business didn't touch, and end up deepening their toes in all the categories. Therefore, when analyzing these businesses, don't try to force them into one category in order to understand their business model. It helps to remember that these businesses' incentives are generally designed to make you interact with their services as much as possible, since this is how they earn most of their cash. Since you are now armed with the knowledge of these major players, let's expand your knowledge bubble to encapsulate the different opportunities companies have to raise capital, sell their securities. Thank you.